Hey everybody, good to be here today. My name's Brent Moores, and it's time for Condors, Calendars, and Butterflies. We do this each week on Fridays, and I see some familiar names in the chat. Glad you're here. And, if you're watching on a recording, glad you're here too. So that's great. Hey, we're going to follow up last week's discussion with a little variation on it. And so I'll get into that in just a little bit, but let me just mention a few things. One, I'm joined in the chat by Mr. James Boyd, who's helping me out. I appreciate that. As you have questions, feel free to type those in the chat between James and myself. We'll do our best to get your questions answered. Also, you can follow either of us on X, at Brent Moore CS, at James Boyd CS for additional content throughout the week, additional financial market related content primarily throughout the week. Now, before we get too far into this though, let me just mention a few things that we do need to cover. These are disclosures. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It is not an individual recommendation or personalized investment advice. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money application, which is what we will be using today, the thinkorswim desktop software application, will not assign a short options position early. That's different from a real trading account where that certainly could happen. Also remember that there's no, if we put stop losses in, there's no guarantee that of the execution of that stop order that it's going to be at or near the stop price. Past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as a sole means of investment research. And I'm not going to be factoring in commissions today on these trades, but just keep in mind, commissions and fees are a real thing that you should consider. Let's take a look at the markets just to kick us off. Right now, we're up, we're up a little bit. This is the S&P 500. I would probably consider this to be kind of a support level where I drew this, what is that, pinkish line, I guess. But the general trend has been up, and along the way of this uptrend, we've had pullbacks along the way. But something to note is, for whatever reason, and there may be different reasons, including I don't even know what day on the government shutdown we're at. There's increased maybe concern in the markets. And there's a lot of different news stories that certainly can affect things. A lot of it may be related to current trade tensions with China, deja vu. But our implied volatilities are going up. Now, this isn't a chart of VIX. This is just a chart of implied volatility on SPX options here, on the SPX options there directly. But it's going to say kind of the same deal. Implied volatility has been going up. So implied volatility does tend to be mean reverting, of course. I think you guys know that. And so, in fact, let me just to kind of illustrate that perhaps, let's pull up a chart of the VIX here. And let me go back a little bit farther in time. Let's go to a 3-year chart here, okay? And just go plain. I just wiped out my 3-year chart. But you can see over time, there's times where the implied volatility goes up. Okay, I'm just kind of looking at the peaks here. Sometimes it goes way up, but it tends to revert back down. So we say implied volatility is mean reverting. And my assumption here today, and this may not happen, implied volatility can go higher. Look, it was at 65 back in July of last year. It went to 60 I think at the beginning of April this year. So it certainly can go higher. I don't know exactly where it's going to go, but my assumption is implied volatilities may settle down here a little bit, okay, on the SPX. So that's going to drive us more towards, there's different options trades. Well, look, some trades do better if implied volatilities go up. And notice I'm saying it goes up, not where it is necessarily. Like if you're looking at a long call, it's nice to buy it if the option's cheap, if implied volatilities are low, and then the implied volatility goes way up. Similarly, if you're doing selling strategies, which is what we're going to look at today, then it benefits you if implied volatilities are higher and drop. Okay? So that's my theory on this as well. Last week, what we did was we did a neutral trade. We talked about iron condors. And if you're interested in that session, I'm putting a link to the chat to it in the chat. If you're watching on a recording and you don't see the chat, just go to the playlist for this class. Okay, just go to the playlist on the Trader Talks channel and you'll see it. And you'll see other content there, such as in our Investing Master series that occurs on Tuesdays, 11 o'clock Eastern Time. Check that class out. James Boyd teaches that class, and I think you will find it valuable. But what if we don't want to do a total neutral trade? What if we're and we're not super bullish? Because look, if we're super bullish, maybe we just do a long call or just buy the stock. Or if we're super bearish, maybe we buy a long put, okay? Or do a short synthetic or something like that. But what if we're kind of mostly bullish, but kind of neutral too? Sort of bullish, sort of neutral. Or sort of bearish, sort of neutral. Well, one thing you can do on your iron condors is you can just change the strike prices. That's the easiest thing. So let me give you an example. Okay, I'm going to pull up Wells Fargo. Okay, here's Wells Fargo. They just had earnings a few days ago. We jumped up on earnings. What's our technical analysis on it? Well, I mean, what I'd say is, in general, look, here's our highs have been getting higher there, right? Our highs have been getting higher. Our lows, we went up, and this one was actually a little bit lower, but after earnings, we jumped up, we gapped up. So I'm going to say, you know, this isn't like gangbusters bullish, it appears, just looking at trend and support and resistance, but it's also not totally neutral either. So I'm going to look for something that's slightly bullish here. And if I'm doing an iron condor, and this is, again, going back to last week, you know, maybe I'd look at a short put vertical down here and a short call vertical down here normally. And if I want to make it a little more bullish, I can just kind of skew up the strike prices just a little bit. And that makes it a little bit more bullish. Or vice versa for bearish. But there's another way to do it. And that is we can go and we can do what's called skewing the iron condor. And there's a couple ways to do it, but let's just look here at this. I'm going to go to Wells Fargo and kind of using the rules that we did last week. We said we're going to go out about a month on these, and we're going to do a short call vertical and a short put vertical, and at the same time, there's your iron condor, but we're going to make a little modification on this. On these, typically, we go out to about a 30 delta, or excuse me, about a 20-ish delta or so. And, or you could look at probability in the money. Okay, so if I go here, and you could always change this to probability in the money, delta, they're going to give you a roughly similar answer, probably slight difference here. And sorry, I clicked on the wrong thing there. But so I'm going to go to somewhere around a 20 delta. Well, I don't have anything that's really that close to 20, but we got something that's about 18 here. And I'm going to look and sell that. So I'm just going to click on the bid price there on that one. Okay. And then I'm going to go to the next strikeout, which is $2.50 difference here on this. And I'm going to just hold down my control key and look to buy that. But we're not done. We're going to do this on the other side as well. And I'm going to go to something sort of in the realm, I guess, of a 20 delta. I'll go to about a 25 delta here on this. And I'm going to hold down the control key, click on the bid price. I'm going to do the same thing. Next strike down, click on the ask price. And then what I'm going to do to skew it, and this is one way to skew it, there's a couple different ways to skew it, is I can just alter the number of contracts here. Okay, I can change the strike prices, or I can alter the number of contracts. In this case, I'm going to alter the number of contracts. Now, if I try and change one right here, it's not going to let me. So I'm going to click on this over here, make this custom, and then I can kind of custom do this. And I'm going to add more contracts on the put side. Okay, so I have 2 contracts now on the put side, and I have 1 on the call side. And then if I want to look at this trade, I can analyze this trade, and just to try and give you a sense for what it looks like when I say I've skewed it, let me just scrunch this in just a little bit here so you can see that. Now what you can see is I'm taking much less loss potential on the upside. So if this thing goes from kind of neutral, kind of bullish to like very bullish, then I'm likely to lose less on that upside there on that. Okay, you see that? So just changing the number of contracts can do that. In fact, let me just put in a strike price. Let me just add in where the current stock price is. Current stock price is right here. Okay, so you see, I can shift this whole thing up if I want by adjusting my strike prices. Here's this current stock price. But you see the difference between this is our break-even point right here. This is our break-even point. And if it goes against us at expiration, that's kind of the risk we're talking about on that. Okay? Because we have a tighter strike price. Because we have more contracts, on the put side, and so the risk on the put side is more. Okay? So there you go. We've skewed that to be a little bit more bullish. Now, let's go back. I'm going to go back to the chart here. And, actually, before I do that, let me just mention one more thing. If I want to look at break-evens on this, break-evens about 76.5, break-evens about 91 or so. So you can add that to your chart if you want. Let me just do this. So break-evens down here, roughly, and here. So if your forecast isn't for it to stay kind of in this range, you want to do the trade, right? We're past earnings, so that is likely to keep volatility down. If we look at implied volatilities on Wells Fargo specifically, here's our implied volatilities up here. We had earnings. Interestingly, our implied volatility right now is a little bit higher than before earnings. That's kind of an unusual situation. Why is that? Well, I think it's just general market implied volatilities that have gone up. Probably there's been a little bit more concern in financials, banks, from regional banks. Regional banks there's been concern lately with regional banks and some loan losses regarding regional banks. Could that spread? Could it spread to bigger banks? Wells Fargo is one of the big boys there. Well, this could be reflecting it just a little bit there. But again, my assumption is here on this that implied volatilities are going to kind of more normalize and come down a little bit there. All right, so that's a trade. That's a skewed iron condor. Now, I'm going to just take a minute and talk about these. And in relationship to last week, if you want just plain old vanilla iron condors, we talked about this in the class last week. I gave you the link already on that. But let me give you a little review. And I'm not going to take the time to write it down, but we're talking a short call vertical and a short put vertical. Typically, we're looking maybe 20 to 40 days to expiration. I say that typically it can go outside that if you want. We're trying to take advantage of time decay. This is a time decay. It's a positive theta trade, these are. Time decay benefits on this trade. It's in case of a skewed iron condor, we're skewing it a little bit bullish or skewing it a little bit bearish. It's not something we'd call necessarily non-directional. We've taken it out of the non-directional realm. In addition, for it to being positive theta, it's negative vega. It benefits if implied volatilities drop. That's true, by the way, for regular, plain old vanilla iron condors and these skewed iron condors as well. The max gain on these, the premium you receive on them. The max loss, it's the difference between the strikes minus the premium. So if you change the strikes, you're changing the potential max loss. Your break evens are going to be a little bit below the short strike price, a little bit above the long strike price. But the probability and your return on risk depend on what strikes you choose. Okay, how far away the strikes are from the current stock price. And typically we're going to look for something around that 20 delta. Remember, delta tells us how much that stock price moves in relationship to, that tells us how much the option is going to move in relationship to a $1 move in the stock price. But it can also give us an idea of probability. Sometimes we'll use delta. Sometimes we'll look at probability in the money. The numbers usually aren't going to be exactly the same, but they should generally be in the same ballpark of one another. In terms of managing these, typically we're going to manage them as short call vertical and short put vertical, not as a complete iron condor. And once we get under the 10-day mark till expiration, often we'll get out of those. Okay, so that's just some facts there, or some, I don't know, some basics of how we're doing these in this particular webcast here. Now, how do you find trades is a question. Well, there's different ways to find trades. Of course, you can do scans for trades. You can look at a watch list. Look, I have a watch list that I use. It's just liquid stocks. Now, you're not going to see this under yours because I just created it. But let's just kind of look and see what I'm using for. Just remember, why I'm using it. Whatever stocks pull up in this aren't a guarantee of liquidity. It doesn't matter what I title the watch list. It doesn't guarantee liquid stocks or liquid options. But, James has a particular way of finding stocks to trade options on. Other people do as well. You got to look at more than just what the trend of the stock is or what the technical analysis of the stock is. You got to consider liquidity. So in this case, all I did to create this list was I just did a scan under the stock hacker. And I just looked at so this list here, if you want it, look, you could create your own. I just titled it that. I just said S&P 500 stocks with penny increment options. That's going to narrow it down a lot. I said the closing price of these stocks has to be at least $20, which is going to be the vast majority of S&P 500 stocks anyway. But I also said the average volume of those it's cut off the edge of the screen. You can't see it there, but I put in 10 million, okay? Is that too high? You don't have to do that. Could you use 7 million, 5 million, maybe, But, 10 million sounds like a massive amount, but the reality is, with the amount of trading that we have in the markets these days, 10 million, a lot of stocks actually meet that 10 million threshold. Okay, so that's what I've done. Once you create the scan, if you go up to this menu right here and save the scan, then what you got is a watch list. So I just pull up the watch list. And then what I do is I go, hey, I want to look for some stocks. I can see which ones kind of have earnings coming up soon. You'll see the blue little dot there. Or I can go on down the list. And I can go, oh, Nike, what do I think of that? Or NVIDIA, what do I think of that? And I could say, is this bullish, bearish, neutral? And then you got to match the trade to what you want. Let's take a look at NVIDIA here while we're here at this one. But just realize, as I'm going through this, you can, that's an easy way to look for potential trades just quickly. And notice I'm just clicking my arrow key, to be honest, on my keyboard to do this because they're linked. Okay, just make sure they're linked. The list there, orange 7, it's cut off, but there's an orange 7 there on that one. Okay, doesn't matter what color number you have there. What's our implied volatility on Nike, or excuse me, on NVIDIA? It's actually gone up pretty high. In fact, it's kind of interesting because this kind of shows implied volatilities in the market. Here was our last earnings. Here was our implied volatility last earnings. We're actually at least as high or higher. So with earnings comes out at the end of November on this stock, I think. It's unless the market implied volatility is driving it higher, there's a good chance just the whole earnings typical implied volatility increase is probably not going to be the driving factor if it goes higher. Again, I'm going to assume that we're going to be kind of mean reverting and that maybe we'll see some easing both in the markets of IVs and in NVIDIA, hence our negative Vega trade. Okay. By the way, there is a survey link in the chat. We appreciate your feedback here. So let's look at a trade on NVIDIA here. I'm going to do kind of a similar type thing, but a little different. Okay. Again, we're going to look at a skewed iron condor. Last time with our Wells Fargo example, we skewed it by just altering the number of contracts, unbalanced iron condor, different contracts. This time I'm actually going to change the strike width on the two different sides from one another. But first of all, what's my trend? Well, I could say, what's my forecast on this? Well, it starts with the trend. Here we go. It was really strong back here, and it kind of settled down. I'd probably say we maybe even had some resistance here. We're kind of flirting that we went above it, dipped a little bit back below. Now it looks like we may be bouncing off our 50-day. So what's your forecast? Well, I don't know what the forecast is, but I'm going to call this kind of bullish, not massively bullish. I'm going to just say it's sort of bullish. And so I'm going to do a skewed iron condor with a tilting it more to the bullish side. Now we can do it more to the bearish side, and I'll give you an example later of we'll look at one that's more bearish too at the end here. But let's do that skewed iron condor, but we're going to change strike widths on this here. So what I'm going to do here is I'm going to go to the trade tab. And I never sent my Wells Fargo trade. The price has moved a little bit on me here, but I'm going to go and I'm just going to confirm and send, and we'll send that order. Okay. All right. So there's Wells Fargo. Let's go. We're going to NVIDIA here, and you can go out about a month. Very often on these, there's a pretty significant liquidity difference between going to weekly contracts and monthly contracts. NVIDIA is like one of the most actively traded stocks out there. It's pretty liquid typically even on weeklies, but we're going to double check. You can look at things like open interest, massive open interest, bid-ask spreads, still pretty tight bid-ask spreads, even though these are weekly contracts. But let's start with kind of standard, and then we're going to tweak a little bit here. So what I'm going to do is I'm going to go to my probability in the money around 20%. Well, we got 21%. We're going to call that good. I'm going to sell that contract. I lost my cursor. There we go. I'm going to go here. I'm going to control click and buy this. Notice that those are $5 apart, 200 to 205. Now let's go to the put side of things. I'm going to go to something kind of near that 20 delta or 20 probability in the money. We got 22 here. I'm going to control sell that. But in this case, what I'm going to do is I'm actually going to give myself a bigger width between this contract. And instead of $5, I'm going to make it $10. Now, the effect is we're taking more risk on the downside in that case, but we're also bringing in a bigger premium. Okay, let me hold down my control key and do that. Why am I bringing in a bigger premium? Because when I sell a contract, Like if I didn't even buy a contract with, if I just sold a contract or do a short strangle or something like that, I'm just selling it and I get to bring in the premium. There'll be a commission there. But once I start adding in legs where I'm buying it to try and help protect ourselves, that's the goal of it, to limit the risk on it, I'm eating into the potential profits. If I'm going farther out of the money, I'm eating in less than I would be if I sold this one. Furthermore, so that's kind of a positive thing, but it also gives me more risk on the trade. It's going to increase the buying power effect on that trade too, as well. So you just got to be careful on those. But there we go. So let me get out of my little drawing tool. Let me pull this up here, and you can see the trade here. Okay, 200, 205, 165, 166. Now, could, if I want to, also change the number of contracts? Yeah, I could, but I'm not going to, because what I want to do is I want to just show you this one right here. Let's analyze this trade. We're looking at this right now, and I think you can immediately see the difference here is we're taking a lot more risk to the downside than we are to the upside. Remember, my thing is a little thicker than I want there. There we go. Here's our break even. And you can see, look, if I'm very bullish, here's the current price right here. If I'm very bullish, I wouldn't want to do this trade. Maybe I'd do a long call or just buy the stock or something like that. But in this case, I'm kind of bullish. If it goes super bullish, I'm limiting my risk. Again, I could shift my strikes up a little bit, and that would effectively, if I shift my strikes up just a little bit, what I could do is it would just kind of make the graph look kind of like something kind of like this instead. Okay? Like that. And if I want to do that, I can. Let's look to do that. Let's shift them up $5 here and just see what we got. So let me go back to, let me go back here. I'm going to make this 210. I'm going to make this 205. This is kind of the beauty, if you will, of this Analyze tab. This is going to be 170. And this is going to be 160. Let me analyze this trade. Okay. Hold on, let me just see if do I have the other one in there still? I do. Let me get rid of, hold on, which is which? Let me get rid of this left-hand column. Okay, this is the older one. Let me get rid of that one. Here we go. Okay. So there, I've just shifted it up. So now it is looking even more bullish. I could shift, I'm not going to do it, but I could shift it up even more bullish if I wanted to. And there we've skewed that iron condor. It's unbalanced now. And there we go on that. Okay. So let me just remind you, we've got a survey link in the chat. Yeah, someone someone observed how much option activity there is on NVIDIA. So pretty much any list of liquid stocks or options is probably going to have NVIDIA on it. It doesn't mean it's the appropriate time to trade a particular trade, but it's a very liquid option there on that. So there's our skewed, unbalanced iron condor there. Okay. So I'll leave it there, but if you're playing along on paper money, and I encourage you to play along on paper money, not a real trade, but on paper money, I want you to look at this and say, hey, maybe I want to compare this. How would I shift this up further? I could make this 210, 215, 175, and 165 if I want to shift it up further. But there's some different things you may consider. Number one, what's our theta on this? Well, theta is positive here. And now if it goes way out of whack, in fact, let's just concentrate on this middle line here, okay? If it goes way out of whack, the stock moves way up or particularly way down, I guess, then our theta is going to turn negative. But it'll turn negative too if it goes up against us far enough. But our theta is positive on this trade. Our vega is negative on this trade. It would benefit by a drop in implied volatility. If NVIDIA goes up in price, it is generally more likely that implied volatilities would drop. Okay, so that would tend to benefit the trade that way. So with this trade, we can benefit from different things. If the stock moves up, we have a positive delta here. We benefit. If time passes, which we know is going to happen, that would tend to benefit the trade. If implied volatility drops, which is certainly uncertain here, but if it does, that would tend to benefit the trade as well. Okay? So let's put in that trade. But I encourage you to double check that and do that in your paper money though. So let me go back here. Here was our trade. I'm going to pull this in. I'm going to go off the mid price just a little bit and confirm and send. And then I'm going to send that order. Now, once that is sent, let's look at NVIDIA here. Okay, here's NVIDIA. Okay, so here's our trade on NVIDIA. When I'm managing this trade, what I'm going to do is I'm going to look at this put spread and this call spread separately. Okay, you don't need to exit the whole thing at once there. All right, let's look at one more example here. Yeah, we got time. Okay. But if you have questions, feel free to type those in the chat. We're happy to help you out there on that. Let's look at another trade, another potential trade. These are all practice trades, of course. And I've been looking at a bunch. Some of them I thought, Oracle, look, I already have a trade going, a paper trade going on Oracle. So I'm not going to tinker with that. That's actually a Iron Condor we have. Did we do that last week? I think we did that last week on Oracle, if I'm not mistaken. And yeah, here was our trade from last week on Oracle. By the way, I do manage trades a lot in a managing an options portfolio webcast, which we teach on Wednesdays at noon Eastern time. So we'll be looking at Oracle as well as these other trades we just did in upcoming weeks as well on that webcast too. Managing an options portfolio Wednesdays at noon. Let's go back to the charts here. You don't have to be bullish on these. If you find something that's more bearish, you can certainly skew it that way. However, just keep in mind, here's Occidental Petroleum. Okay, I'm not going to do a trade on this one because remember, you do your forecast. I could see obviously this could do anything. I could see this rebounding strongly because it came down so strongly. I could see it continuing down at a rapid rate because it's been descending at a very rapid rate. And of course, it could go sideways, which would be more appropriate for an Iron Condor, but or even a skewed Iron Condor. But this, if your view is significant bullish or significant bearish possibilities, this would not be the trade for you, right? So I'm going to go down. Here's one that I saw, Schlumberger, where I thought, hey, look, this is looking a little bit more bearish. We just had earnings on this. So let's look at our IVs on this, in fact. Let me get rid of this. Let me go to implied volatility. Okay. Here we go. IVs dropping, as you'd probably expect with earnings. After last earnings, IVs started a lot lower, but we ended up down here. In fact, it was another month or so, actually a month and a half probably, our IVs were way down there. Okay, so that's what we got here on this. IVs dropping potentially significantly lower. Again, depends on what the overall market does. But if we have the negative Vega, the negative volatility forecast, then what we're going to do is we're probably going to be more likely to do a negative Vega trade, such as an iron condor. But what I'm going to say is this: we've been going down. Now I can do a, if you want moving averages, you can always throw on moving averages to try and help you. We're below our moving averages. General trend has been going down, but a little bit, a little bit more mixed. So I'm going to say slightly bearish on this. So let's do the same thing on Schlumberger. We'll start with just kind of a routine iron condor, and then we're going to tip it off balance a little bit here. Now, here's 28 days to go till expiration. Let me go to my probability ITM there in the money. And our spreads actually aren't that bad. I was thinking they were going to be a little bit worse. They're actually not terrible there. But if you go to 35 days, go to the regular monthly contracts, usually they're going to be a little bit better. Let's see what we got. 23, well, about the same probably, but I'm going to do this one. And so what I'm going to do is initially I'm just going to sell my standard vanilla iron condor. And then we're going to tweak it. Okay. So what am I going to do? Number one, I'm going to tweak it I'm going to make it more bearish, which means that I'm going to spread out on the call side a little bit more. Strikes are every $2.50, I think. And then, if I wanted to change the number of contracts, I could. But let's take a peek at this. Let's analyze this. Remember, we're looking a little bit bearish. Here's the current price. Let's adjust those strikes out just a little bit, one notch here, and see if we can make it a little bit more bearish. So let me go here. And I'm just going to shift everything down by 0.25. 3250. 3750. 2750. 25. Okay, now let's do this. Let's analyze the trade again there. And now you can see we've actually, wait a second, right here. Here's our current price right here. So you can see I pretty significantly skewed this more bearish here in this case. And so there you go on that. So we can do that way. Let me go and I'm going to place this trade. Let me get rid of that. Go to our trade tab. I'm going to then just knock that off the mid price because I want to get filled on that. And I'm going to confirm and send. And we're going to send that trade. There we go. Okay. So we just added 3 different unbalanced iron condors. We talked about different ways of skewing that iron condor to be more bullish or bearish. We talked about 3 different ways of doing that. 1, shifting the strike price. Just shift them higher if you want it more bullish, shift them lower if you want it more bearish. We talked about putting unequal number of contracts of calls versus puts. And we talked about not doing equal width on each side. Okay, so having them wider on either the call side or the put side to make them more bullish or more bearish there. So I'd encourage you to try that out as you go and just see how it goes for you. See if the if you have one of those in-betweener trades, I'm bullish but not super bullish, or I'm bearish but not super bearish, but I want to take advantage of the time decay, because often when you do these bullish trades, you end up with, like a long call, you end up with a big time decay drag on your trade. This is not going to be that. So anyway, thank you very much for joining me. Thanks for helping me out in the chat, James. Everybody, coming up next, we've got market and sector analysis. That's at the top of the hour. Also, before you go, let me just mention this. If you have not subscribed to the Trader Talks channel, make sure you do so. If you have not filled out the survey, we always appreciate your feedback. There's a survey link in the chat, and always love your feedback. And if you have suggestions for future topics or something like that, feel free to put those in the survey. I read whatever you put down, I do read. So I just appreciate you guys. Thanks for joining me. Everybody have a wonderful day ahead and a nice weekend ahead as well. Bye-bye, everybody.